My first post this week was about the 10% tariffs on Canadian energy imports that we heard about toward the end of last week. I wrote about an example showing what would happen in a world where we had these 10% energy tariffs. And I demonstrated effectively that you could see three different outcomes. One is that the producer, the Canadian energy producer, could sell their oil at the same price to, say, a US petroleum refiner. They could then make their petroleum products available to end consumers at an elevated price, basically pushing the impact of the tariff onto the US consumer. We could see scenarios where the US refiner instead takes the hit, and we see less profitability in the US refining sector. We could see a scenario where the Canadian energy producer takes the hit so they can sell their energy into the US at the same rate that would have existed without the tariff. So the Post argued that we'll see some sort of mix of three different effects where Canadian energy prices come down, which impairs the profitability of Canadian energy producers. US refining profits come down, which again impairs the financial performance of the domestic refining industry, or US consumers end up paying more for their fuels than they had before the tariff. Some blend across those three. At the moment, it's a moot point with the tariffs put on pause, but we'll see what happens, what kind of resolution reaches. But if we see any kind of tariffs imposed in the way that the Canadian tariffs were described, those are the kinds of implications we should expect to see on the back end. My second post was about Baker Hughes. And Baker Hughes, like SLB and Halliburton, recently released their 2024 annual results. And what we saw interesting, while all three tell very similar stories around oilfield services, the Baker Hughes stock rose pretty aggressively, while Schlumberger and Halliburton's stock price are both down. The question is why? The answer is that Baker Hughes is not exclusively levered against oilfield services. Baker Hughes has an industrial and energy technology segment that SLB and Halliburton don't have. That IET segment is where you find a lot of the LNG work that Baker Hughes is rightfully applauding and that the market's hearing a lot about. So there is a whole segment of the Baker Hughes business that exists separate from the traditional oilfield services sector. And we're really seeing a divergence there where that IET segment's growing more quickly. It's more profitable. Investors are clearly more excited about it. And so there's very interesting dynamics, even within Baker Hughes, that you have these two different segments that have natural alignment in the sense that they're both targeting energy markets broadly, and there's a global presence around both of those. But the structure of them, the capital structures, the way that investors are responding to those, the way the markets are evolving for those are very different. And that creates both some challenges and some opportunities for Baker Hughes. I wrote about all of that in my second post. My third post was about Drill Baby Drill. The Wall Street Journal published a piece this week where they had interviewed some executives for U.S. oil producers. They had interviewed some folks at the top of the Saudi Arabian oil field, and the conclusions were the same, which is just production is not going to rise strictly because the U.S. federal government now has a drill baby drill philosophy. You're going to need to see oil prices go up in order to motivate more drilling. And that's exactly the opposite of what the new U.S. administration is trying to accomplish by promoting drill baby drill. If you can get U.S. producers to drill even more aggressively than they are right now, you can get production, which is already at record levels, to shoot up further. That would drop the price of crude oil, and that would be a good thing for the U.S. consumer, which is why basically every U.S. president in modern times has wanted to see oil prices go down. But the industry right now is not positioned in a way where even if you start removing regulations that exist in the oil field today, if those regulations somehow aren't tied to price increases from here, you just won't see much of a drilling renaissance. And instead, a lot of that excess capital will find its way into the hands of shareholders in the form of dividends and share repurchases. In that post, I also showed some break-even oil price analysis for several different U.S. independent oil and gas operators. And what we see is that the U.S. administration is targeting a $45 per barrel price, according to the Wall Street Journal piece. And that is a price below which, over half of the oil field, the U.S. oil field, requires more than $45 per barrel in order to generate just an operating profit, not a net profit. So there's a bunch of reasons why we won't see an aggressive drilling increase into the teeth of oil prices the way they are now. You would need to see some kind of oil price uplift in order to drive a drilling activity uplift here in the U.S. My next post was about China. As you might know, I have a book club where we're reading The New Map by Daniel Yergin. It's one of the most fun things I've done. I like reading energy books generally. It is so much more fun to read them with a group. And so we are discussing the new map as we go through it. And in one of the chapters of the new map, Daniel Yergin presents China's energy mix. And so what I did was pulled a bunch of data from the Energy Institute's statistical review of world energy, and we looked at what has happened to um, energy from coal, from oil, from gas, from renewables in China from 2020 to 2023. And I showed that renewables, as you might imagine, is seeing the most growth in an absolute sense. It's seeing the most growth in a relative sense, in the sense that it's contributing more to a larger fraction of China's total energy production. We're seeing coal as a as a fraction of total energy production to come down over time. And my point in that post is that we don't need to even gesture toward climate change to motivate the uptake of renewables, right? That's not why China is investing aggressively in renewables. And Daniel Yergin talks about in the new map that around the world, there is just a big push to pursue energy security, energy reliability, energy affordability. And that's what China's doing. And that's why you would simultaneously invest aggressively in solar and wind and build new coal plants because China has abundant coal reserves and is an incredibly inexpensive form of energy. So that's why we're seeing what might look like an odd juxtaposition of energy sources if you're coming at it from a sustainability perspective. But there's so much more in the sustainability that matters. And even in those cases, when you're talking strictly about the reliability of your energy supply, the affordability of that energy supply, you can still see a strong uptake of renewables like we're seeing in China. My final post of the week was also about Canada. This time I talked about the US oil imports, and we looked at the fraction of those imports that come from different oil producers. And Canada produces or is responsible for over 60% of US crude oil imports. It is the dominant player. Second place is Mexico, which contributes less than 5% of total US imports. My point in that post was if we do get to a point where we're imposing tariffs on energy imports from Canada, that is the dominant fraction of US imports. And US imports on the whole are about half of the total production level inside the US. So imports are a very important component of the US crude oil landscape. And of course, Canadian crude oil imports in particular are even more influential than what we see from all the other countries that we import oil from combined. So when we talk about tariffs on Canadian energy imports, it is a consequential portion of the fabric of US energy. Each week, I put together a free newsletter that has links to and summaries of all the research that I post online during the week. That way, you don't have to rely on social media algorithms to surface all the stuff that I'm publishing. I also include an energy related anecdote, insight, or observation that I don't share anywhere else. So even if you've seen everything that I've published online, you'll still have something new to read in the newsletter. If you haven't signed up to receive that, you can click the link in my profile. I'll also put a link down below. Totally free. It's super easy to read. I write it in a way where it takes less than 4 minutes to read through the whole thing, and it's a just good way to stay on top of some of the most important dynamics that I have found in the energy markets over the course of the week. As always, thank you so much for reading, watching, liking, commenting. Really appreciate it. I hope you had a fantastic week, and we will talk soon.